Strip away the noise, and making enough money to call yourself wealthy comes down to three specific paths. They are straightforward to understand, but brutal to execute. The first path is the act of building a new, value-producing entity and retaining ownership of it. This graph illustrates the mathematical ceiling of a salary. The flat line represents income, which remains linear because your output is strictly tied to hours or negotiated compensation. Contrast that with the sharply curving line, equity. Ownership has no ceiling because it scales independently of your physical labor. Founders achieve wealth that is decoupled from their personal effort. Their net worth tracks with scalable metrics like revenue growth, profit margins, and market dominance. In the software world, a company growing from $2 million in annual revenue to $20 million can see its valuation multiple move from 4x revenue to 8x revenue. That represents 10 times the growth in revenue, but a 20-fold repricing of the owner's equity. Reaching the highest financial tier requires a complete detachment of personal output from financial return through the vehicle of equity. Building an economic wealth engine requires 5 sequential steps. Identify an unmet demand, create a repeatable solution, standardize the delivery, scale the distribution, and retain ownership. Most founders fail at step 5. They give away too much equity too early or fail to formalize systems, effectively building a glorified job instead of an autonomous machine. Structural leverage comes from distribution and margin control. A mediocre product with superior distribution can dominate a market, while high gross margins provide the cash flow required for continuous reinvestment. This power law curve shows the reality of startup outcomes. There is a massive clustering at zero, where most businesses fail. But the potential upside is asymmetric. A microscopic tail extends to extreme wealth, where a few outliers return everything. Market timing often does more work than individual genius. Building in an expanding market compounds a founder's effort by providing a natural tailwind. The builder's path exacts a high psychological toll. It requires a tolerance for extreme volatility and constant exposure to market forces without a salary cushion. Building a startup is a cold exercise in engineering structural leverage. You are creating a repeatable system designed to produce predictable cash flow at scale, operating entirely without its creator. The second path is acquisition. Instead of the chaos of creation, you allocate capital into productive systems that are already operational. This chart shows how productive assets decouple wealth from daily effort. Compounding means that your returns generate additional returns. If you invest $20,000 a year at an 8% return over 30 years, the explosive upward curve only materializes in the final decade. This mechanism requires true productive assets, those that generate cash flow or earnings. Pure speculation, like buying an asset simply hoping to sell it to someone else for a higher price, lacks the intrinsic value needed to compound sustainably. Consistency historically beats short-term market predictions. The greatest threat to the investor path is emotion, specifically the tendency to buy during optimism and sell during fear, which interrupts the compounding process. The investor path trades the operational intensity of building for the severe discipline of leaving capital uninterrupted for decades. The bridge path is built for high earners. It involves positioning yourself at the center of existing, highly leveraged industries, like finance or technology, to extract outsized income. Compensation follows the scale of impact. A software engineer building tools used by 10 million users creates exponentially more economic value than one writing scripts for a local firm, even if the work itself is similar. The critical transition happens by securing proximity to capital. High earners move past hourly billing and negotiate for stock compensation, profit sharing, or carried interest. Aggressive conversion means turning every windfall and equity grant into capital immediately. If a specialist earns $400,000 and lives on $120,000, they are deploying over $250,000 into assets every single year. High-income skills provide the raw fuel for wealth, but they are not the destination. Their only purpose is to provide the capital required to eventually buy your way into the ownership class. All three paths converge at detachment. This is the phase where a portfolio of assets generates enough continuous return that human labor becomes entirely optional. At this inflection point, the wealth slope steepens. When you can maintain annual reinvestment on multiple six-figure sums, the yield on your assets eventually crosses the line of your fixed living expenses. None of these paths are easy. Building requires enduring chaos, buying requires starting capital, and joining requires elite skill and timing. The singular requirement for generational wealth is the transition from a system of labor to a system of ownership.